Joining us today, Shari B. Olefson is a Florida bar certified real estate attorney with Fowler, White & Boggs. She is an educator. She is a recognized expert in the current mortgage crisis and author of a book called Foreclosure Nation. Shari, we're glad to have you here today. Hopefully you can give us some help for all those struggling people out there.
Yeah.
Now, when you started writing this book a couple of years ago, it wasn't nearly as bad as it is now, was it?
No, actually, when I started writing the book, the experts were predicting about 2 million people nationwide would be going into foreclosure, and as you know, the number's already up to 5 or 6 million. So it's been significant, but you have to remember back then what we were looking at was interest rate resets. Remember the whole thing with the subprime mortgages and those huge the initial teaser rates and then the huge jumps. So the federal government was really looking at those numbers and saying this is how many people we have into those loans. These are when the rates will reset. So we can expect about 2 million foreclosures.
So we thought that those people would fall off the map, lose their homes, and then the financial structure would just move on.
It would kind of absorb it. And we thought that that was going to be the main reason. But look at what happened. As those people started falling off the edge, other things sort of started clicking into place. We started seeing unemployment. We started seeing decreases in retail sales. We started seeing decreases in the gross domestic production, all kinds of other things that led to additional problems and spread into our broader economic system. And so those foreclosure numbers on a nationwide basis spread.
You make the point that when you look at some recent financial crises in the past couple of decades, savings and loan crisis, things like that, that the collapse of those systems and the fraud involved there affected the people who sort of played in that game. But now, this has affected every single American. I mean, it has trickled down to everybody.
Well, even if you didn't play
in the bubble,
exactly.
If you didn't buy in the bubble.
Doesn't matter. The value of your home has gone down. And again, there's somewhat of a vapor element to that, because if the value went up in what we're calling the bubble and then it went down, the question is, you know, it's a philosophical question, did you really lose that money? But even if you didn't play, the value of your home has gone down, and that, of course, is one of the reasons that we're seeing so many people upside down in their homes. And you know, here in Florida, we have about 1.5 million people who are upside down, and some of the new statistics actually came out this morning that there's a 75% increase in foreclosures over last year in this state. And one of the reasons, of course, and one of the reasons we went from that 2 million number to 5 or 6 million is because of that other factor, homes prices going down and homes becoming underwater. So
for the folks at home, I'm sure everybody knows, but meaning that you owe more on your home than it is worth right now.
Exactly.
You're underwater.
Exactly. Now, most of those people, of course, were people who did buy during the bubble, because if you've owned your home for a long time, then you know, you have
paid it down enough.
Yeah, you've paid it down enough. One of the things that's a little scary, and I think Alan Greenspan came out a few days ago and said this, that if we do see a price depreciation nationwide of another 5% or so, we're now going to start impacting those people who did put a significant down payment down, maybe a 20 or 25% down payment in a more conventional mortgage as opposed to a subprime mortgage, and those people may start to become significantly underwater in terms of their loan as well.
But you know what I'm hearing, Shari, is that some people who find themselves underwater are walking away. They're just walking away from the homes instead of, okay, I can still make the mortgage payment, I'm going to stay in here and hope that I will eventually recoup my value, and they're walking away. Is that a good thing to do?
Well, you know, you're asking on two levels, and this is an interesting sort of, again, a philosophical question. As an economic decision, I mean, economic decisions can be made in isolation. And if you're not going to recover that money, then strictly on paper, maybe it is a good thing to do. From a legal standpoint, one of the things that we counsel people to do, and this is an added resource too, is our website, foreclosurenationthebook.com, where people can specifically ask their own question and we respond to it. But one of the things we counsel people to do is to consider the long-term implications of what you're going to do. So whereas walking away from your home may theoretically save not having to pay down an additional $50,000 or $60,000 more than your home is worth, facilitating an agreement with your lender may allow you to qualify for a new mortgage in the next couple of years sooner. So I think Fannie Mae requires 26 months for you to wait if you have a voluntary repossession with the bank. If it's a foreclosure, then it takes longer for you to qualify for your next mortgage again, even though they both hit your FICO score the same way. So there are sort of long-term implications that you want to think about. But the other thing is what's been referred to as moral hazard in our country.
Moral hazard.
That's the whole concept of how do we feel about someone walking away from their obligations?
How do we feel?
And culturally, how is that going to change our country? I mean, if our kids grow up seeing this, if our kids grow up around hearing foreclosures and knowing that, oh, the neighbor walked away from their home because they were upside down, what type of a message are we sending? And I like to put that in the context of thinking back to how you might have felt about that 5 years ago. And if I had said to you 5 years ago, oh, so-and-so bought this house, but now he's lost money on it, so he's just going to walk away from the mortgage,
it would have been horrifying.
I suspect you would have thought that was not a very honorable thing.
But the moral thing is, Sherry, that our parents modeled a different model for us, which was you put 20% down or more, and you attempt to pay off your mortgage, and you only bought what you could afford to pay for, and that model changed. So where's the morality there of people who got in for nothing?
Right, but it changed because of us, too. It changed because we allowed it to. We're talking about sort of cultural phenomenons. And the thing is, Kathy, these are not things that are tracked on statistics. I mean, you turn on CNN any day, and you can see foreclosure rates and home sale reductions and inventory rates and all of those things. You don't see the cultural changes. You don't see the changes in cultural attitudes. They happen over the course of 100 years. One of the things that amazes me is when you drive down the street, and you see this all the time, those signs that say, bad credit, no problem. I would like to know, when did bad credit become no problem? But, you know, the interesting thing is that we pass those all the time without thinking twice about it. So for you and I, when did we start passing those signs without thinking about them? When did we start passing them?
It is a cultural shift.
It really is interesting.
Let's take a break. I want to talk about some statistics going on in the state of Florida, in our own Tampa Bay area. And again, the biggest complaint we get every single day on this program is, I try to negotiate with my bank, they won't talk to me. What is wrong with that? We'll be right back. Shari Olefson, author of Foreclosure Nation. She is with Fowler, White & Boggs, and a real estate attorney and educator. Let's start with Rosie and Sebring. We've gone through foreclosure. The judgment came down on April 30th, although shortly prior to that we had a contract in our home for a short sale. Then the judgment came. Now we can't get in touch with the lender. Oh, surprise, surprise. I hear this every day. There's too much red tape. It's a shame we can't get help. Move fast enough to get the short sale through. Now no one will live in the house for a while. It's just an awful situation. I bet on when people email you, you hear this all the time.
Absolutely. And anyone who wants to is welcome to email us at foreclosurenationthebook.com.
And I will email them back?
Absolutely. I do respond to all of the emails. I do sometimes share them with other viewers on the blog so that other people can learn from that, but absolutely.
But why do the banks not negotiate with people? Why is it not in their best interest? It seems like it's totally counterintuitive.
Right. Well, and this goes to one of the causes of this whole issue in the first place. And I'm a huge advocate against not playing the blame game, but I do think that looking at it and talking about it in the context of being able to learn from it is something that's very important. There were really 5 or 6 causes, and it's interesting because the first 3 of those have to do with us. They have nothing to do with anyone else. They have to do with our comfort level with using credit and having debt in our lives, which has historically grown over the last 100 years.
We're very comfortable with it.
The biggest change with that happened when credit stopped being something. When your grandfather went to go get a loan, he'd get dressed up in his Sunday best, he'd go to the bank and ask for a loan, and that banker knew him. And that banker would be making the loan and putting it in his drawer. So he was on the hook if it didn't get paid back. And sometimes our grandparents were denied credit. And that was sad because sometimes they should have had it and maybe they could have improved their lives with it. But sometimes they were really protected from themselves. In our lifetimes, credit became something that was priced. So if you wanted to get credit and you were a higher risk, they'd still give you the credit, but you'd pay more for it, which is sort of counterintuitive. The other thing is it became much more anonymous. The whole delocalization of banking and the mortgage industry, it stopped being something that went in the banker's drawer, and thanks to Wall Street taking our mortgages and chopping them up and selling them to investors all over the world, it became something that no one was really going to be accountable for. So the people we were dealing with really didn't care if we'd ever pay it back or not because it wasn't going to be their problem.
So that's why they're not getting on the phone with you?
That's why they can't just change the rules, because they have contracts with these investors that they sliced up our loans to and sold them to, and part of those contracts say that the loans that you're selling us are not going to default, or you're not going to modify them, and if you modify more than, say, 5% of them, you have to buy back some of them, or you have to insure us, or you have to make payments to us. And so there's a conflict there where it's going to be detrimental to your servicer or your lender sometimes to be modifying your loans. That's why they just, when you hear about these lawsuits, they just can't. Well, the other reason is that the banks really were hit by surprise by this whole influx. They weren't expecting it, and even though it's been a year or two now, they're still really not ready for it. And one of the things that's delayed that has been government's intervention.